Hong Kong stocks endured their worst day since the 2008 global financial crisis, just a day after Chinese leader Xi Jinping secured his iron grip on power at a major political gathering. Foreign investors, shocked by the outcome of the Communist Party's leadership reshuffle, dumped Chinese stocks and the yuan despite stronger-than-expected GDP data. They fear that Xi's increasing seizure of power will lead to the continuation of Beijing's existing policies and further weigh on the economy. Hong Kong's benchmark index, the Hang Seng HSI, tumbled 6.4% on Monday, marking its biggest daily decline since November 2008. The index closed at its lowest level since April 2009. The Hang Seng Tech Index, which tracks the 30 largest tech companies listed in Hong Kong, fell 9.7%. The Chinese yuan weakened sharply, hitting a fresh 14-year low against the US dollar in the onshore market. In the offshore market, where it can trade more freely, the currency plunged 0.8%, hovering near its weakest levels on record. The sharp sell-off came a day after the ruling Communist Party unveiled its new leadership for the next 5 years. Xi not only secured an unprecedented third term as party leader, but packed his new leadership team with staunch loyalists. A number of senior officials who have supported market reforms and opening up the economy were absent from the new top team, raising concerns about the future direction of the country and its relationship with the United States. Those pushed aside included Premier Li Keqiang, Vice Premier Liu He, and Central Bank Governor Yi Gang. It appears that the leadership reshuffle spooked foreign investors to offload their Chinese investment, sparking heavy sell-offs in Hong Kong-listed Chinese equities, said Ken Chung, chief strategist for Asian Forex at Mizuho Bank. With the Politburo Standing Committee composed of President Xi's close allies, market participants read the implications as President Xi's power consolidation and the policy continuation, he added. The possibility that policies such as Zero COVID, which has resulted in sweeping lockdowns to contain the virus, and Common Prosperity, Xi's bid to redistribute wealth, could be escalated was causing concern, Chung said. Mittal Kotecha, head of emerging market strategy at TD Securities, also pointed out that the disappearance of pro-reform officials from the new leadership does not bode well for the future of China's private sector. The departure of perceived pro-stimulus officials and reformers from the Politburo Standing Committee and replacement with allies of Xi suggests that Common Prosperity will be the overriding push of officials, said Kotecha. Under the banner of the Common Prosperity campaign, Beijing launched a sweeping crackdown on the country's private companies that shook almost every industry to the core. The market reaction, in our view, is consistent with the reduced prospects of significant stimulus or changes to zero-COVID policy. Overall, prospects of a re-acceleration of growth are limited, said Kotecha. In China's tightly controlled domestic market, the benchmark Shanghai Composite Index fell 2%. The tech-heavy Shenzhen Component Index lost 2.1%. GDP data cannot lift sentiment. The market slump came despite the release of better-than-expected economic data. China's economy grew 3.9% year-on-year in the third quarter, according to the National Bureau of Statistics. Economists polled by Reuters had expected growth of 3.4%. The GDP data marked an increase from the 0.4% increase seen in the second quarter as China's economy was hit by widespread COVID lockdowns. Shanghai, the country's financial center and a major global trade hub, was shut down for 2 months in April and May. But the growth rate was still below the annual official target set by the government earlier this year. The outlook remains gloomy. said Julian Evans-Pritchard, senior China economist for Capital Economics, in a research report Monday. There is no prospect of China lifting its zero-COVID policy in the near future, and we don't expect any meaningful relaxation before 2024, he added. Coupled with a further weakening of the global economy and an ongoing slump in Chinese real estate, any headwinds will continue to weigh on the Chinese economy, he said. Evans-Pritchard expects China's official GDP to grow just 2.5% this year and 3.5% in 2023. Monday's GDP data were initially scheduled for release on October 18 during the Chinese Communist Party's Congress.